when bankers refer to, and others refer to hybrid transaction offerings, they're really referring principally to pipes and registered directs. These are transaction formats that have attributes of private placements and attributes of public offerings, therefore hybrids. Hybrid offerings have actually been increasing in popularity for almost a decade. If one were to adjust for the financial crisis, from 2001 until about 2007, I think that the frequency and volume and deal size of public offerings has increased virtually every year. I believe the reason for that is when the public markets are volatile and uncertain, pipes and registered directs present a very good alternative. In the case of pipes, principally because issuers are able to ascertain whether or not there's a deal out there that they like before there's a deal announcement and before they commit substantial money toward trying to get a financing completed. It's essentially the same story with a registered direct. For U.S. public companies, a pipe is a private placement coupled with a trailing resale registration of the securities sold in the pipe. The advantages for an issuer in using a pipe are speed, cost, and certainty of execution. A pipe is almost invariably a transaction that can get completed within 2 weeks to 3 weeks, sometimes actually even in a more rapid time frame. The cost of undertaking a pipe is substantially less than that associated with an underwritten public offering. And finally, as to certainty, really one of the greatest things about a pipe is that an issuer will be able to see whether there is a transaction available, who the investors are, and what price they're prepared to pay before there's any public knowledge that the company is contemplating a transaction, and also before they have undertaken the cost associated with getting the transaction completed. The disadvantages associated with executing a pipe are that pipes tend to be priced at a discount to market. From the standpoint of purchasers of pipes, they also have to be aware that there may be times when the resale registration statement that they would typically benefit from, when its use has to be suspended. Those are called blackout periods. One of the principal rationales supporting pipes, and one of the most attractive features of a pipe, is that it permits issuers to explore whether or not a transaction is available without having to make public disclosure. And in fact, the first time when the world learns that a pipe is underway is when contractually binding commitments from investors have been entered and the company makes a press release that the deal has been contractually committed to. For many reasons, pipes have been the transaction of choice for lots of issuers. For some issuers, those who have existing shelf registration statements, there is a variant of a pipe that is, under many circumstances, even more attractive. That's called a registered direct financing. And a registered direct financing is, in essence, an agency public offering. So for SEC registration purposes, it is a registered transaction. From the standpoint of issuers and the bankers who sell these transactions, actually they are marketed in most instances quite like pipes. And the only difference is that the initial sale from the company of the securities is, of course, directly to investors pursuant to a registration statement. And that means a couple things. One of the things it means is, if advisable, registered direct offerings, which typically involve larger institutional investors, might also be marketed to retail investors. The real appeal of a registered direct is quite similar to the appeal of a pipe, and that is that they can conduct on a confidential basis conversations with potential institutional purchasers and determine whether there exists the likelihood that they can get a deal executed before the knowledge of the financing becomes public. And if they secure commitments from institutional investors, then they can round out the book with retail investors or others if they care to do so. And typically, registered directs involve a smaller discount than pipes, and that appeals very much to issuers. And by the way, the reason the discount is smaller is that with registered directs, the securities trade on a when-issued basis, and therefore investors do not have to take a liquidity risk for any period of time, whereas in a pipe there is at least a hypothetical liquidity risk in between the time the transaction closes and the resale registration statement is declared effective. Actually, registered directs resemble pipes in a couple of ways. One of them is the way they're sold. Typically, they're sold in the same fashion that pipes are sold. The difference is you're dealing with an SEC registered public offering, albeit on an agency basis, and the transaction has to comport with the requirements of the SEC best efforts underwriting guidance. As to the way they settle, because there is a distinction between pipes and registered directs there, registered directs tend to settle through the DTC system. So we're asked frequently, how does a registered direct, which is a best efforts public offering, differ from an underwritten public offering? And in point of fact, an underwritten public offering really contemplates that the investment banks or financial intermediaries will purchase directly from the company the securities for resale to the public. A registered direct is different, or a best efforts offering is different, in that the securities are sold from the issuer directly to the purchasers, and the investment bank acts as an agent as opposed to an underwriter. So that's the structural difference. But in reality, it's really interesting how things have evolved over the last 10 or 12 years. Because in fact, most of the time, we don't see underwriters who are prepared to purchase and go forward with an underwriting until they're certain that there's requisite demand there and they can resell immediately the securities. So if that's the case and they're taking price risk only for the briefest period, in essence, there is not a whole lot of difference as an economic matter between an agency best efforts deal and an underwritten offering. These days we see a lot of wall-crossed or pre-marketed public offerings. They are in essence an underwritten public offering, and if anybody looks at a final prospectus, it's often impossible to tell that it has been a wall-crossed transaction. But wall-crossed transactions start out with essentially solicitations of selected groups of institutional investors on a confidential basis. And after the bankers and the company have ascertained that there is a high likelihood of a transaction, if they have sufficient certainty, then they launch the transaction with a press release and a preliminary prospectus, just as you would any other underwriting. So that's a wall-crossed deal. And what's, from our perspective, kind of interesting and in a way heartening is that if we look at the technology used with wall-crossed transactions, it resembles that of a registered direct very closely, because the initial period of sales activity on a confidential basis, I should say solicitation activity on a confidential basis, is almost identical between a registered direct, and a wall-cross deal. So what you see is that these private and hybrid and public offering technologies are tending to merge, and there is a continuing coalescence of the attributes. And that, for us, portends a very interesting and lively future.